They can, and this is about waiting until things are starting to break. It's a ridiculous thing. But the thing is, I think they also need to understand that you can just take a simple chart and looking at it and say, well, when the economy starts to roll over, we get a recession. What does the rates then do? And then you see that the rates will often then decline into, or the yields, market yields will decline, and then the Fed will have to lower them later on. I know they're not too far. The Fed is not too far behind the 2-year yield, the government yield, but at this point here, they should start to think, okay, we're seeing so many things and so many signs of deterioration, and it's actually in the housing market, and we are just, I mean, to me, it stands, vividly in my mind that it's just 17 years ago we had, the financial crisis, and we had, the housing market crisis, and I just honestly cannot understand how they cannot see that we have something like that brewing again.
Yeah, it's scary, I think. And they've gone from being data dependent now to forecasting. I think that's what Powell said recently. It's looking at future forecasts. You're like, hang on, how does this work?
Yeah.
Anyway, you watch the bond market at all? Because I think that's where there's quite a lot of concern at the moment with sort of yields, especially long end yields rising quite a lot globally.
But again, people don't understand the business cycle, and this is normal what you see into, and you can just go back again. Also, it'll only be 14, 15 years. You'll see that it's actually also into what you see always is that the yields are the lagging indicator on the economy, which means that you'll have first the housing market starts to move. The yield spreads will start to move, and you'll see that then they will lead the real economy. Then you'll see the employment start to move, and then you'll see the market yields will move. And it's simply that kind of sequencing that most people do not understand. I don't think there's any problem in the bond market at this point at all. I mean, this is a talk of the town again, because they don't understand that they simply are the last ones to top. So when the business cycle is topping, the employment and so on is topping and starting to move lower, then you'll actually see that the long-term yields will also start to. And that's also why you get the yield spreads will start to spike, because you'll see that the long-term yields will stay higher for longer, and you'll see the short-term yields will start to decline. That's why the yield spreads are actually something that you can follow. And they are not really spiking yet, which is a good thing, because that means that the recession is not really here yet. But in terms of the business, in terms of the yields, I mean, we've seen this movie before, and it's the same every time. I do think, though, we moved into a new inflationary regime, which means that yields in the long time frame is going to move up from here, but not on the short time frame. Short time frame, the yields are going to move down. The economy is under pressure. I mean, it doesn't require a PhD to understand if the housing market is frozen solid, and you see the number of existing homes being the lowest that we have seen compared to the size of the US population, that there's not so much demand for housing mortgage loans. I mean, that's the applications are just, in the gutter. And what does that drive? Well, that drives that, the yield levels on these will be coming down at some point. That's simple like that. It just has a lagging effect.